So, welcome everybody, and thank you so much for making it here this early in the morning, 8:30, at least speaking for me, I hardly even, wake up by this time, but thank you for being here. So, let me start a little bit with my own journey. So, a lot of people may think that AI is this newfangled thing that came up after ChatGPT. As it turns out, it's actually a pretty old, pretty long journey. I remember 30 years ago, here in India, when I was doing my undergraduate at IIT Kharagpur, I wrote my first paper in IEEE neural networks, which is now called neural networks, is what is the technology underneath what we now call deep learning. Then I grew most of my career in the Valley. I did my PhD at Stanford, worked in the tech industry, got a lot of patents, founded and successfully exited 2 startups, and worked as a technologist and an executive at tech companies like Samsung, Intel, Lockheed, Tiaco, and so on and so forth. Now, in 2015, I took a right turn in my career when Reliance wanted to build this large 4G network, the most technologically advanced at the time, called Geo. I started as their chief data scientist and saw this incredible journey of 200 million or more Indians getting connected all of a sudden within the span of 7 months. I stayed back to see the development of e-commerce on that when, at Myntra, I actually was instrumental in the first commercially available Gen AI use case, TechShape, that too in the fashion industry, which went on to be acquired by Walmart, and so forth. Now, fast forward to now, I'm here at L&T Finance to head AI and data in order to what I see this incredible next step for India. So first, India got connected, right? The country with the largest volume of mobile data aggregated, at the lowest price perhaps in the planet. On top of that, we are seeing this incredible growth of not only e-commerce, but even government forms and other things getting digitized. The India stack, UPI, Aadhaar, and so on and so forth. Now, all that forms the basis for where we can take India next by unlocking credit to the masses. To unlock that value using frictionless services for the credit needs of the millions and millions at the bottom and mid-level of the pyramid, and in a way that is personalized, that serves their actual needs. Now, how are we going to, now, before I talk about how we are actually going to go about doing that, let me just start with a little bit about what is AI. So, in its most basic form, AI simply refers to the simulation of what an intelligent human would do with a computer program. Be it learning from data, like, for example, creating customer behavior models, be it predicting something, like whether a customer is going to go delinquent on their loan or not, or be it generating, which is, here's a customer question, what should be the answer? Now, the important thing to remember is while we all think that because of ChatGPT, AI is the same as generative AI, they're not quite the same. AI is a much bigger, bigger field where you can even consider things like rules-based decision making, like, for example, somebody making a decision on a loan based on somebody's credit score, or somebody simulating the performance of a portfolio, what would be the expected losses, and so on and so forth. Now, those, while they technically fit within the broad definition of AI, isn't what actually made this field shine. It's when we realized that these programs don't need to be hardwired, but they can actually learn by looking at examples of data and then building their own rules by learning from that data. That's when we started unlocking this Pandora's box. So in came machine learning. Machine learning is still a very relevant and portion of AI, and often the workhorse. You can use machine learning very effectively, and we are going to talk about it, in underwriting models, in collection propensity models, and a whole host of other things. Now, while machine learning is something that the world knew for a long time, about 20 years ago, a specific branch of machine learning, neural networks, when applied at scale over lots of data and over large number of nodes, large parameter sized networks, did we realize that it can actually make sense of unstructured data. So not just numbers in a column, but pixels in a picture from which you can figure out whose face is in that picture, or a waveform of audio from which you can figure out what somebody is saying. So that was the beginning of what we call deep learning. And deep learning is also still relevant in some of the applications that we are going to talk about. But then the next stage, where a group led by Dr. Vaswani and others unlocked this new algorithm of transformers, where they could correlate sequences of tokens, sequences of words, or areas of different pictures, and figured out the attention mechanism. So the attention mechanism led to transformers, which, when stacked up on one on top of the other, led to what we now call GenAI. And this is something that has taken the world by storm, and we are adopting it in ways that are both conventional as well as somewhat non-obvious, and we're going to walk through it. The next stage where GenAI is going is agentic AI, where we combine rules-based things along with generative things. So while generative AI is good for some things, rules-based engines are still hallucination-free, and merging them together gets us the best experience in many cases. Now, with that background, let me now start with something more down to earth. This is probably a scene that we have all seen many, many times. So the dirty secret of Indian e-commerce is that it rides on top of these two-wheelers. Now, each of these two-wheelers cost about 2 lakh rupees. The people who are using them in order to deliver packages and make their income, they are hardly making about 15,000 a month. And they don't have a lot of money in their bank account to pay for one upfront, hardly sometimes enough to even make the down payment. So how do you know if somebody is given a loan that costs almost half of their income, whether they will actually be able to repay it or not? It's a hard question. And that's why traditional ways of lending to the thin to credit population does not quite work. Because they don't have a credit history, right? They haven't taken a loan earlier, and so the bank says, no, I can't give you a loan. Well, and then they have a pretty irregular income pattern, gig workers, that's the nature of it. And they're probably young people just starting off, so not a long history of financial transactions and so on and so forth to actually back up their claim. And to make it all even worse, the amount of paperwork that you typically need to get a loan at being a gig worker at such an early stage of life, perhaps not having a fixed address, it makes it almost impossible. So that is the reason why the traditional credit sources end up making them an offer that they can't refuse, that they can't accept, sorry. So, why? Because if you look at this population, more than a third of them, almost 40% of them, don't have any credit history at all. And even those who do have a fairly thin credit history. The result, the typical offer goes out with a down payment requirement of 30%. We went through the math. That would not work for this fellows, right? And an interest rate that's also pretty high. So what happens? So a lot of lenders make them offers, including us, we used to, that almost half of them are not palatable enough for them to pick up. So they just walk away and continues the vicious cycle. So we took a methodical approach of solving this problem by not just looking at credit history data, but also at things like their bank statements, with their permission, of course, what kind of things they were paying for, their payments info from payment aggregators, and also geointelligence based on where they live and how affluent or otherwise those areas are. We took each of these data sources and fit a model of that predicted delinquency for each of these data sources based on all of the historical data that we had, having been in business for many, many, many years. And we could then come up with models with a reasonable level of accuracy. The laser doesn't work here. Do you have a laser? So with a reasonable level of accuracy for these individual models. But we did not stop there. We realized that there will be times when somebody may have both a credit bureau record and a banking model. And so even though the bureau record may be a little thin, the combination of that can increase their Gini, which is a measure of information measure of accuracy, to quite a substantial bump. Even for people who do not have a credit history, we can use their banking models, the payment models, the geolocation intelligence, and come up with a much sharper razor with which we can separate out the better from the worse customers. We did that by ranking the customers into segments based on the predicted delinquency probabilities, the predicted chances of them going delinquent on their loans. Now, this looks simple on one slide, but it actually took 16 different scorecards all over to get to this point. Now, what did we do with the segments, though? So we gave the best offers to the best segments and progressively worse ones as the segment at the lower and the weaker parts of the segment. For example, we gave segment 1 an average down payment requirement of only about 2.5%, and an interest rate that was quite decent. while the segment 5, which is the riskiest, in order to cover our risk, we increase down payment requirement 20%, also increase the interest rate for yield. Now, what it did to the customer population is very interesting. So we saw that 8 out of 10 of the best customers actually picked up their offer. So the ABND, which is approved but not dispersed, is the percentage that's walking away. So 22% of them walked away at the best segments, while in the worst segments, more than 3/4 did. So you can see the effect of that in how the customer distribution changed from blue to yellow. Blue was before we launched Cyclops, this new underwriting engine. Yellow is what it did to the mix, what Cyclops did to the mix. You can see that we now have a much bigger percentage of the better customers than we used to. The result, not surprisingly, our delinquency rate fell, and fell by a lot, by 64%. So this is an early indicator of delinquency, by the way. This is a measure of net non-starters, meaning people who just don't pay even from the first month on. However, this drop in delinquency did not come at the cost of growth. In fact, it was exactly the opposite. So we ran an A/B experiment. So the control, which is in yellow, is the set of dealers who were not in the Cyclops program, while the gray is the ones who were in Cyclops. We launched Cyclops somewhere in June, and over time, we slowly ramped up the percentage of loans getting processed through Cyclops. What we see is that the approval rates are picking up on Cyclops almost like a hockey stick curve, while for secular other reasons, the other leg continues its otherwise decline. So this proves that what we are after not only improves profitability, but it's also a growth engine. However, what does it do to the customers? We are on this side of the table, right? So we can look at all the data in the world. In order to answer that question, we collaborated with a university, Shivnadar University, the MBA class of Professor Pramita, and we asked them to understand by directly talking to the customers and dealers, what are they finding? The finding was very interesting. This seamless, under the hood look at their patterns and then discovering that, oh, this person can still get a loan even though others have declined them, it comes across as trust. Now, Steve Jobs had this very famous saying that a technology that is sufficiently advanced is indistinguishable from magic. Trust is rare. Trust is human. And in this case, trust is magic. Now, it may appear that, okay, with all this data that we are using in order to make these decisions, is the cost of that data too much, and so ultimately it's a Pyrrhic victory? Turns out it is not. So we came up with this concept of RODI, return on data investment. Quite simply, it is the number of is the amount of credit losses we are saving divided by the cost of the data that we use to acquire them. And we are doing far better, actually, compared to the premium bureaus. And we will, as a result, keep continuing on this journey of acquiring more and more data and broadening the number of dimensions with which we look at these customers and trying to make our decisions. An example of that is we did not just stop at urban India. We went to rural India as well. L&T Finance is one of the largest tractor lenders in India. And the problem with tractor loans is that it not only depends, the delinquency rate not only depends on the individual, which can be seen with all of those other data that we talked about, which we are using, but also how their land performs in terms of the soil quality, the rainfall, the temperature, and so on and so forth. So we wanted to see whether machine learning can pick it up, and it did. So this is one tiny portion of a decision tree model that we augmented those other ensemble models with, and it clearly shows that we could actually distinguish a land that would have good patterns versus bad patterns of delinquency rates of a tractor owner using that land to make his living. We are incorporating this into our tractor loan products, and it's going to go live next month. These are only two examples of a whole host of things that we are doing at in machine learning at L&T. We have 6 lines of business. For two-wheeler loans, we are using it for premiumization strategies, like we talked about, for developing better scorecards, but also after the customer onboards, we are using it for monitoring delinquency and preempting it. We're going to talk about it a little later, and also finding out fraud, which I won't have the time to go through it, but is another way in which machine learning shines. Specifically by using unsupervised machine learning, we are able to find anomalies and hence fraud patterns. On the rural side, for our microfinance portfolio, which is the biggest portfolio of loans that we have, we're using it not only for policy guidelines, but also for profiling these customers using a whole variety of data, including unstructured data, and we're going to go over those. And also to use those signals to cross-sell loan against property, which is a slightly different product, to them. In personal loans, we are in the process of partnering with a whole host of sources, which are our, let us say, our large partnerships, who bring their own customers to us, and we're going to, we have already announced a couple of partnerships there with Cred and others, and we are going to also make another announcement today. So these scorecards come with signals just like the inputs that you saw, but then they need to be made into a model, and that's where machine learning shines. On housing loans, one of the interesting things that we have done, and if you go next door, you will see a demo of it. We're using GenAI for a chatbot that can do a much better job than others. We're going to talk about that as well. And in farm finance, which is tractor loans, we talked about how we are using it for the cycle for tractors, but also how we are going to use it for cross-sells of other products like warehouse financing and stuff like that. And finally, we have a growing SME business on which we are in the early stages of building certain propensity models and premiumization models that are due to take shape very soon. Now, all that I talked about so far was all our structured data, right? Numbers in a column. 90% of the data in the world, however, is unstructured. Especially so in rural India, where microfinance is changing the lives of millions and millions of women. These are poor women taking about 40,000 rupees a shot for their loans, and it makes a big difference to them in terms of their empowerment, in terms of them taking financial control of their lives, and making that journey out of poverty to eventually climb into the prime category. The challenge, and we are ourselves a big player in this market, where we are present with microfinance loans in 16 states, 200,000 villages, having touched the lives so far of 13 million women. The big challenge here, however, is that most of these customers don't have that much digital footprint. All of this data that I talked about in two-wheeler Cyclops, a lot of them don't have bank accounts, don't have a credit history, do their transactions mostly on cash, not on PhonePe or something. So how do we find the signals that indicate it better from a worse customer? That's where GainAI comes in. So one of the things that we do when onboarding a MFI customer is our FLO, our field agent, goes to their house and snaps a picture with not only the omen for KYC purposes, but also the picture of the house at the back of them. Now, these pictures contain hints. Is it a single-floor house, multi-floor house? Does it have painted walls or plaster falling off? Does it have a good, strong door or a broken one? None at all. Is it a brick house or is it a kacha house, which is made of weaker materials and stuff like that? So we used a multimodal LLM where we not only use the picture of the house, but also give it some questions that tries to extract all of these hints out of that question. And then we give it multiple examples, which is multi-shot learning, and say that, okay, this particular house, because it has this, scores at this level and this at that level. Now, here's a new example. How will you score it? That simple prompting exercise is giving us a score that we then use to differentiate the better customers from the worse and send them for our micro lab sourcing team, who can then go and figure out whether they qualify for a loan against their property, which becomes a secured loan as opposed to just unsecured loans that they were earlier on. It's not the only example of how we are trying to understand lifestyle index of a customer from pictures. We also do what's called a video PD, a video personal discussion, for loans above a particular limit or that cross some guardrails. And we actually have a video discussion. Somebody at our end asks the customer to open their camera and have a discussion about why they're taking the loan and so forth. In addition to the points of the discussion, as a result, we can actually see inside somebody's room and get an idea, again, using LLMs, using multi-shot learning, and get a score of how the inside of their surroundings looks like. We believe that such signals contain, such images contain signals of the behavioral pattern of a borrower in terms of how organized and how affluent and how much propensity they have towards actually honoring their commitments for the loan versus not. We're in the early stages of modeling these signals, and we will see how well it turns out. Just to complete the story about signals from pictures is, of course, Google Earth. If you know a customer's home address, we can look up how that place looks like from the sky. The picture on the left is that of a fairly well-to-do area in Mumbai, and the multimodal LLM that we prompted actually could figure out some good characteristics from it, which kind of nudge us towards thinking that, okay, this is probably an affluent area. The picture on the right is that of Dharavi, biggest slum in the world. And it does figure out some signals that tend to veer towards a more closely packed and small areas with not very good roads and stuff like that, which again point to a less affluent area. Again, we are in the early stages of extracting lifestyle indexes from these and using them for subsequent decisions. These concepts of using of lifestyle index, by the way, is something that we filed a patent, and hopefully we are going to get an IPR advantage from it. But that's not the only way that we are using Gen AI, especially in the MFI, in the rural finance segment. Like, for example, one of the problems for the MFI segment is whether somebody is going to actually give back their loan or not. And that's indicated by whether they're actually attending the monthly meetings or not. So we are using Gen AI to find, actually we are using a deep learning-based model to find whether people whose KYC pictures we know appeared in a group picture or not. And based on that, we determine who has skipped the meetings and hence probably has a higher propensity of being delinquent on their loans. Unstructured data is not just pictures, it's also free text. One of the hardest things is to understand the level of resiliency of a customer even before you have given them a loan. And for that, we are rolling out a set of questionnaires to these women, and the questionnaires are deliberately intended to not have a right answer. But then we can find signatures of their psychometric parameters, their level of consciousness, their level of morality, their feeling of obligation towards that loan, and so on and so forth. And those are extracted from freewheeling answers that they give, whether in English or their native tongue or any which way they want. The questions for these have been rolled out, and we're going to see whether we can actually make a model out of this. Now, if you notice, this is a little different from the traditional use of Gen AI. Specifically, we are here using an LLM to score out an index from which are actually input into a broader machine learning model. So this is a case where we are not using Gen AI as the final solution, but a tool that is acting like a classifier, that is acting like a regressor, and then sieving it up with traditional ML. I'll skip, for the sake of time, the kind of theoretical implications of it, but very briefly, we are essentially trying to use the fact that ultimately Gen AI uses an embedding vector underneath, and from that vector, we are extracting signals that are used in supervised models. I'll skip this, because I wanted to come to this idea that now bring it all together. If we bring all these signals from all these data sources, we can do something magical. We can find prime customers way before they have become prime. We can find that, okay, somebody has a good phone, lives in a good locality, goes to good schools, builds a business with premier customers and so on and so forth. They're probably on their way to becoming prime. And then we catch them and give them the prime treatment so that they stick with us when they actually become valuable. We're going to do this with a system called Nostradamus, where after somebody has been given a loan, we actually periodically look at all of their data signals that we talked about in Cyclops and score whether they're going up on that scale becoming greener, for which then they qualify for cross-sells, upsells, and so on and so forth, or whether they're going down and we can proactively say that, okay, this guy now is somebody for whom we need to do some collection actions, and we can do those collection actions way before they actually go into a overdue mode. Now, at the end of the day, we are in the business of serving humans, for which we need to give them an interface at scale that can talk to them as a human. The industry have tried to do this with chatbots, and they have generally been a failure. They aren't really conversational. They're ill-equipped to answer most questions and give up too early. Sometimes they even say, okay, give us this number in exactly this format. Not a very human-like thing to do. And sometimes they just appear like click, 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 a menu. We are reimagining the idea of a chatbot which can be conversational, where you can actually have a human-like conversation, while at the same time being very precise when it comes to numbers. You want an amortization schedule, here it is, download it, bookmark it, come back to it, all of that, and which instead of being hardwired, can adapt to how you are talking and give answers that way. You want to switch from English to Hindi? No problem, it'll keep pace with you. You want to give it cryptic answers, it will keep pace with you. And finally, from menus, we are making it far more interactive, where it pops up widgets, unlike a chatbot, with which you can, within the chat, understand how things are going. This uses a RAG as well as agents underneath in order to make all this happen. And best of all, you can go check it out at the demo booth next door, where you will not only find our knowledgeable AI guy chatbot, but also examples of a lot of the things that I talked about here. So welcome to RAISE, and enjoy the rest of your day. Questions, anybody?
Can we please pass the mic for questions?
Can you hear me? Good morning, everyone. First of all, thank you, sir, for the very insightful session. My name is Jay Shankar. I am Director Solutions for a firm called Innova Digital. I am heading the entire financial sectors practice. Very interesting topic you brought about. My question related to the microfinancing, right? The example, sir, you quoted, I just want to clarify one thing. Are you focusing only on secured loan?
On secure loan, no. So the microfinance examples that I talked about are clearly unsecured loans. And also, we are going to take it to personal loans, PLs, which are also unsecured.
Okay.
We have a portfolio that, while it is increasing towards secure loans, there is still a substantial amount of unsecured loans where these techniques actually have the biggest potential.
So just to clarify, you are also into unsecured loan, right? Just want to confirm myself, because my follow-up question is based on that one. Right.
So the simple answer is both. Both secured and unsecured loans can take advantage.
Yeah, thank you. So my exact question now, the problem with the rural financing, as you said, is the data. Very first thing, right? You won't get data, you don't have anything, credit history, all the thing is hard reality. But when you're focusing on unstructured loan, for the data, for your model generation, everything, you are focusing only on the house picture or one of the parameters, right? There are cases, one of the parameters. There are many cases in instance, many in India particularly, people might not have a own house, right? Right? What happens? And house is not only the one parameter we need to consider. People will take a loan for small scale business, whatever it is. How you ensure that your loan is you get a guarantee that you will get return back from in terms of data or building a model? That's what my question.
Yeah. So as I mentioned, that it is one of the signals. Secondly, while it may or may not be the house that they own, it is a house that they live in, which is ensured by the fact that the picture is taken at the home address given on the application. And finally, the machine learning model at the end is a supervised model, which is trained on past performance. So that's how we ensure it. I think we have a great session at, in about 4 minutes in the other room.
Ladies and gentlemen, can we have a big round of applause for Dr. Banerjee for starting our day on such an inspiring note?